Today on the CEO Barbecue, we're looking into a company that actually makes money, but they make money from the waste material of the world's largest underground copper mine, which is operated by Codelco and is, of course, located in Chile. To tell us more about it, I've got Amerigo Resources here with us. If you want a bullet point summary of this and all the other CEO barbecues in your inbox once a week, go to resourcetalks.com and subscribe to our free newsletter. Now, although the company you're about to hear from has not paid us for the production of this interview, you should still not treat this video as research. Research is conducted by reading the company's official filings, which you can find on setterplus.ca. In any case, please only watch this if you absolutely know what you're doing. This interview is intended only for experienced junior mining speculators because mineral exploration, development, and mining is an extremely tough business where failure is the norm and should be the expectation. This is going to be a conversation that is general and impersonal in nature, and it is also going to contain forward-looking statements. I am not a licensed financial advisor, and my business sells content-producing services, which also makes me biased. Although this company has not paid for the production of this interview, it doesn't mean they won't become a client in the future. They might. So before continuing on, please talk to an independent investment advisor with a good long-term track record because your capital might be at risk. If you're not 100% sure you understand 100% of the disclaimers I just showed you, please go to the last section of this video and do not consume this content unless you fully understand and agree with everything said therein. That all said, Amerigo is listed as ARG on the TSX main board, where over the last 3 months, the average volume has been about 250,000 shares. The stock's 52-week high is $2.05, and its 52-week low is $1.50. With a market cap of just over 330 million Canadian dollars and 164.5 million shares outstanding, today this is a $2.02 stock with a 50 and a 200-day moving average at respectively $1.80 and $1.75, which means the stock is now trading above both of them. And as you might have noticed, they're also trading close to the 52-week high. As a matter of fact, it's actually at a 17-year high right now because the last time the stock was here was May of 2008. Now, this is where I'd normally walk you through the full share structure and talk about the number of warrants as well as the number of fully diluted shares and the expected dilution. But unlike most companies I interview, this is actually a cash flow generating company that is currently paying a dividend as well as buying back stock. So there are no warrants and the options are held by insiders. And so the number of shares outstanding is actually expected to go down as opposed to up, which it typically does with the companies I normally speak to. So instead of that, I'll just briefly go through their Q1 financials here to give you a better idea of how much money they make and what things look like. Amerigo's Q1 2025 print shows a company that's still spitting cash, but now walking a bit of a tighter rope. The revenue held at just over 44 million US dollars, while net income fell by 23% to about $5.5 million, mostly due to a planned mill shutdown, which lowered their copper output by 17.5% to just over 13 million pounds, and also pushed their cash cost to $2.22, although they do expect to lower that when you annualize that over the year. We'll talk about that later on in the conversation, of course. EBITDA margin is now at 34%. And on top of that, we have so it's a 58% effective tax rate. There's an almost $7 million, and that's US dollar sustaining capex, and a $4.4 million pay down of trade payables. That's what's shrinking the operating cash flow to just under $2 million after working capital moves. Free cash flow to equity came in at $4.8 million, 96% of which was immediately returned via a 3-cent dividend and a $1.1 million share buyback program, which again, we'll also discuss later on in the interview. Management reaffirmed their full year guidance, though, of just shy of 63 million pounds of copper with, again, a sub $2 cash cost target once normal throughput time or throughputs resume. We'll talk about that as well. And whether that's a realistic target and whether or what else Amerigo has planned for this year is something I'm hoping Aurora will be able to tell us more about later on in the conversation. But the more interesting part here is that, as I mentioned at the beginning, Amerigo is not an actual miner. They do make money from copper, but they don't have mineral rights. They don't have a mine and they don't extract any ore. What they do make their money from is a copper concentrate, which they extract from the reprocessing of the tailings at Codelco's El Teniente copper mine, which is, again, the world's biggest underground mine. They do that under a tolling contract, which runs to 2037. And it also can be revised every 3 years. What happens in between, what happens after that is also something I'm hoping this conversation will provide insights to. But for this to actually become a conversation, I might have to consider shutting up already. And Aurora, giving you the word here. But first of all, thank you so much for being here today.
Antonio, it's good to be here. I really appreciate the opportunity of chatting with you.
The pleasure is mine. I appreciate your timing, and I'm looking forward to a different CEO barbecue for once, where I don't have to check for the normal shenanigans and that they're often present with the companies I interview. So let's maybe start this one off a bit differently, and a bit selfishly, I suppose, because as an investor, who's bullish on copper myself, I looked at your presentation and kind of the first thought that hit me was, why should I care about Amerigo specifically instead of an explorer or a developer, or even a copper miner who's also got, copper price upside like you do, but also operational upside in the form of a potential discovery or discovery growth or whatever else may have you. Whereas what your income and the money you return to shareholders is mostly tied to the copper price. So I don't know if that's even a question, but why should I care about Amerigo as an investor who's bullish on copper?
Well, if you're bullish on copper, I think Amerigo is a great story to consider in terms of longevity. You may believe that the copper cycle is going to last a year, 2 years, 3 years. We think that there are structural changes coming along, and that will reposition copper in a different setup altogether from where it has been in the last 20 years or so. So if you align to that vision, which basically is stating the world is going to be needing more copper, but it's going to be more and more difficult to produce that copper, and to produce that copper responsibly and with the adequate social license, then a logical question would be, who will be still producing copper 10 years from now, 20 years from now, 30 years from now? And it's only the big mines that are going to be able to do that, or the new discoveries that we don't know who they are yet. We produce all of our copper from processing the tailings of a mine that has been in production since the beginning of last century. And that has a projected a mine of life to 2085. So if we are to continue being the partner of choice to process those tailings for El Teniente until 2080, and we are able to continue making money as we have for 30 years, processing those tailings, producing additional copper, and selling it to the market, then I think we are a more than logical choice to consider.
Lots to touch upon there. And definitely your contract there that I mentioned that it runs up to 2037. We'll definitely get to that point here, Aurora. But what's the break-even copper price for you? Like, what is the point at which you're not making but also not losing any money?
I don't know, because we have forgotten about that metric. I'll tell you what copper price we would not be paying a dividend instead. And that's for this year, $3.80. And this year is a different year because this is the last year in which we still are making debt repayments at the tune of around 21 cents per pound. So once you take that away, our dividend inflection point is $3.60. So if you talk to me about at what point you're not making any more money, I would say it's going to be close to the 310, 315 copper price.
Mm-hmm. I do want to talk about that debt. We'll definitely get to it. I got loads of questions here, so I do hope that you have 2 hours for me or something along those lines. But what about copper sensitivity to the upside? I mean, for let's say every 10% increase in copper price from here on out, how much of a return in the form of dividends and buybacks does that result in?
We present that information on our, and I know you're going to be showing that in our when you put the visuals. We try to be very transparent to that. And if you look at our presentation for 2024, we tied up our guidance to two metrics, EBITDA and free cash flow to equity. Free cash flow to equity is essentially the money that is available for distributions to shareholders as dividends, buybacks, and also the withholding tax that we have to pay to bring that money back to Chile. So we started that guidance for this year at a conservative copper price of $3.80, and we guided at $3.80 on average for the year 2025. We would be producing an EBITDA of $56.3 million and free cash flow to equity of 14.1. And then we have different data points in our presentation. We actually built our budget and our guidance for the year at a copper price of $4.15. You may think today that's a very conservative price. That was actually the average LME price for the full year 2024. And so we took that number as the basis to construct the 2025 budget. And what we're saying is we have, under those projections, an EBITDA of $66.7 million and free cash flow to equity of $21.5 million. And from there on, our sensitivity, for example, at $4.30, you have $3 more, $3 million more of free cash flow to equity at $4.70, which is very close to where we are at today. EBITDA jumps to $82.3 million and free cash flow to equity to $32 million. So the sensitivity at higher copper prices is quite significant to us. And that's where we stop our presentation at $4.70. We're not showing you what could happen at $7 or $8. We're going to be talking about our royalties. There's a point where our royalties get adjusted at. So, for us being a transparent issuer, we wanted to present real numbers, and those are the real numbers. So you go all the way from a $3.80 copper price that's giving you an EBITDA of $56 million to a $4.70 average copper price that gives you an EBITDA of $82 million in 2025.
Again, loads to touch upon, and I hope we'll touch upon everything that you said there. I think you've mentioned in your presentation as well that you don't need to factor in CapEx essentially during the process of developing the company, growing the company. But how come? I mean, tailings processing plants are not forever. They age, need maintenance, and so on and so forth. You had some CapEx accounted for in your Q1 as well. So what's the sustaining CapEx that you expect here this year as well as over the next 5 years?
We've never stated we don't have CapEx in the company. We've stated we don't have growth CapEx. And growth CapEx is the high dollar value, the capital intensive CapEx that's required to move your production from point A to point B. We've already done that, and it's tied up to our debt. We grew our production consistently since the time Amerigo was bought at when we were producing around 25 million pounds of copper per year to our current production. This is our target production. This is where we want it to be. So we're already there. We've been there consistently for a number of years. That has been a catalyst to the deployment of our capital return strategy. So we don't need huge amount of CapEx to continue growing the business. That doesn't mean that we don't do CapEx. We do CapEx in three ways. We do CapEx as sustaining CapEx to keep that plant in tip-top condition. That plant is our livelihood. We have to take care of it, and we do. We do risk mitigation CapEx. So we sit down and we look at what could go wrong and how can we ensure that it doesn't go wrong. And we do optimization CapEx. So the combination of those three, sustaining, optimization, and risk mitigation CapEx, is around $13 million a year, which is what we have guided for this year. So we are, first and all, investing in ensuring that that asset is in good shape, that it is a safe asset, that we can operate continuously, that we don't have problems, interruptions, and unexpected shutdowns.
You are right. One of the points that you make in your presentation here says that you don't require growth capital early on in the presentation, which is why you can return capital to shareholders. But what about after 2037 when the contract runs out? Is that just the end of Amerigo, or like what happens after that?
I don't think 2037 will be the end of Amerigo. And let me give you some historical reference to that. Our asset, our company in Chile, which is called MVC for Minera Valle Central, was founded in 1992. And Amerigo bought it in 2003, but it has a history before us, and it's an important history to consider. The original contract that MVC had with El Teniente to process their tailings ran 10 years, so 1992 to 2002. Somewhere in the middle of that, they had a series of contract extensions. When Amerigo bought MVC, that contract ended in 2021. And years before that, in 2014, if I'm not mistaken, we extended that contract to the current term of 2037. We expect to continue doing that. There is no logical, economic, productive idea that says that in 2037 you turn down the switch and you stop producing this significant amount of copper. It's a contract. It has a long term. It's actually perhaps one of the most long-term contracts in the Codelco roster of contracts. It is a strategic contract, and we intend to continue extending that in the future as we've done in the past. So I don't see 2037 as pack up and leave. It's just another date that has to be dealt with, and it will be dealt with sufficient time to ensure that there is a good negotiation, constructive dialogue, and good conditions going forward to continue doing the work we've been doing for 32 years.
Talk to me a little bit more specifically about this contract here with Codelco and what happens to it in the meantime. Like, what does that look like? Can they hike the royalty if they just felt like it, essentially, or could they just walk away at any time? Like, what are the contingencies in place?
No. A contract is a contract. I mean, we're not there, as guests. We have a legal agreement that has been in place in one shape or another for 32 years in a country that has a high regard for law and for corporate transparency. So I don't see that as any issue. It's a contract that establishes quite clearly what we need to do, what El Teniente needs to do, and both parties, do their part and are happy partners and happy recipients of the benefits that the contract generates.
Mm-hmm. I think they can review the contract every 3 years, though. They did it in 2024, if I'm not mistaken. They didn't walk away or anything like that. So they'll review it again in about 2 years. Now, what I'm asking here essentially is what stops them from just walking away during that review?
You can stop me at any time if I'm very precise about the use of language. There is no review of the contract. There were 3 exit clauses in the contract, one occurring in 2021, one in 2024, and then every 3 years there could be an exit clause. But in order for those exit clauses to be triggered, it's not, okay, it's 2027, I'm giving you notice that the contract is terminated. There are a series of conditions that need to occur, and one of them is that the cause of termination of the contract has to be triggered by events that could not have been foreseen by either us or El Teniente at the time we entered into the contract. So that definition in and by itself basically eliminates any triviality associated with termination. It's not, I'm going to terminate the contract because economic conditions have changed, or because there's a change in government in Chile, or because I don't like Amerigo as much as I used to like it. No, there's no room for flakiness there. It has to be a very specific, legally grounded circumstance that could have not been predicted by any party, in the ordinary course of business when setting up the contract in 2014. So essentially, it's very difficult to trigger those clauses, but there is a termination provision every 3 years in the contract, and we've gone through 3 of those date points, and they have come and gone, and nothing has occurred.
That's a bit broad though. What would that look like? Like what's a condition in which they could review it? Is there specificity to it?
If there was a condition under which we could terminate the contract or they could terminate the contract, we probably would have discussed it on the table and would have said this is something that we could expect to occur in the future. So it's essentially it is protective language that has to be there, but I don't see that there is any real business rationale supporting that language.
So it's not like copper goes to $7 and they're like, oh, we can make more money if we do it ourselves. We'll build our own thing. That's not something they could do.
No.
Okay. Well, actually, a bit more to that point, or well, to the point of the copper price, at least, if copper goes to 550, which it isn't too far away from now, actually, the royalties do escalate to 39%. Is that right?
We have two different copper royalties, and we also have a moly royalty, and we can speak about moly in a little while if you want. We have the fresh royalties, and perhaps it's just difficult to start talking about the whole business and dropping in the differentiation here, but um, anyways, when we step out of the top dollar value range for the two royalties that we have in place, and we can review what those are, we basically have to wait for 2 months of average prices at that level, because there could be a spike in copper prices, and a 1 day or a 1 week of a higher spot copper price doesn't mean that those conditions will persist over time. But if there are 2 consecutive months of LME average copper prices above that range, then we sit down with El Teniente to do one thing, to continue the slope that sets that royalty factor, which is tied up to copper price. The royalties that we pay to El Teniente in payment for them letting us work with their tailings, it's their tailings. We have the right to receive their tailings in our concentrator plant, extract copper from that, extract moly from that, and then we return the tailings to them. So the compensation for letting us work with those tailings is the royalty, and the royalty is going to be based on two things: units of copper produced, so production, and also there's a royalty factor that is tied on a sliding scale to the copper price. The lower the copper price, the lower the royalty factor, and vice versa. So if you get at the data points of the formula that's established in our contract, there is a slope, and you just continue that slope upwards and or downwards. In 32 years of relationship with Codelco, there has only been one instance where we fell outside of the range of the price range of the royalties. That was for moly, and that was on the downward side. And basically the discussion was very straightforward. Here's the slope, here are the data points, that's it. So it's not a full reopening of the file and a big renegotiation. It's basically a continuation of the economic parameters as set through a formula.
Yeah. Where does that stop, though? Is there a ceiling to the royalty?
You basically continue paying that royalty factor associated with the rising copper price. I guess at some point in time, there will always be a margin available to us. There's that provision in the contract, right? The revision of the royalty factor has to ensure that you continue with that slope, but that there is an equal distribution of benefits between both parties. And that has been basically the building point of the success of this negotiation. It has been a win-win relation for MVC and for El Teniente. Yes, at different copper prices, there's a slight redistribution of that benefit, but there's an expectation that there has to be a fair distribution of the benefits of the business between both parties.
So it's not like copper goes to something astronomical, and I'm not suggesting it would, but $15, and at that point you basically, you make no money because it's all royalty. Yeah,
No,
essentially.
no.
Yeah. Okay.
No.
Good. Well, it's good that you have it in your contract not to work for free. I might have to consider that for myself as well at some point. Um, actually, this whole conversation, thinking about it right now, looking at the questions that I've written down here, Aurora, I'm essentially going to try to read Codelco's mind here, which cannot be an easy task. So I'm hoping you'll be helping me out with it. But I think Codelco is currently it's developing as a company. I think they're currently targeting a 15% cut in their inland water use, which they want to achieve by upgrading their thickeners by 2027. So could switching to higher density or filter tailings negatively impact the gravity channel that you rely on?
Does slurry that they send out from the mine to the concentrator still needs to be transported? You need water. You need water to bring those tailings down, not just to our concentrator plant, but to their tailings deposit, which is 30 kilometers down from the concentrator plant. And so you can optimize water usage, but you cannot eliminate water. And it still needs to have that. It still needs to be coming down 70 kilometers from the mine to the tailings deposit.
But your plan could still work with it if it was, again, higher density or filter tailings. You can still process that.
Yeah.
Yeah. Okay. Also, if I'm reading this correctly, Codelco is also studying backfill paste and magnetite extraction plus high density transport straight to its Koren impoundment. Could them moving forward with something like that impact their willingness to work with you or something like that? Could that be one of those unforeseen circumstances?
Look, I cannot comment on any of El Teniente's plans or projects. Whatever they're going to be doing, they're going to be doing that. I don't think that it will have a significant impact on their ability of continuing to produce those tailings and for those tailings to continue being mostly transported in the conventional way through the transportation channel.
I think it also might help, or maybe I should have asked this earlier, but to talk to me more about the relationship between you and Codelco. Because when I think about Codelco, it's more like it's almost like thinking of a larger entity that could be intimidating to work with or something like that. How does that work with you? Like, what's the relationship? Do you talk? Do you sit down for a monthly conversation? What does that all look like?
Most of our relationship on a day-to-day basis is not with Codelco, as you describe it, but with the El Teniente mine. El Teniente is Codelco's flagship operation. It is the entity with which we have our contract. Yes, it is part of the Codelco umbrella of companies, but our day-to-day relation is on an operational level with the El Teniente mine people. And yes, our people at MVC are continuously in contact and monitoring what's occurring with El Teniente because we are part of we're part of their DNA. Our plant is connected, obviously, to the mine and to the Koren tailings deposit. So whatever occurs upwards has an impact on our operation. And they also have to ensure that we can operate fully and without creating any disruption on the process of transporting those tailings downwards to Koren. So it's an intimate operational relation.
But it's not like you sit down for lunch with Ruben Alvarado every month or something like that.
No.
maybe unfortunately, or maybe not.
No. I think it's not necessary. We know the people at Teniente. They know us. We have mutual respect and appreciation for what each one does. But if you're talking about is it intimidating working with Codelco, it's not intimidating. It's an honor. I mean, they're the world's biggest copper producer. It's like the royalty of copper. We're working with the foremost copper company of the world. We have been doing that for 32 years. So for us, it's a privilege to do that and to do it in a way in which they consider us a reliable partner, so to speak.
And in the end, they do make money off of your operations, right? That's what it comes down to.
Absolutely. They have monetized their tailings through this agreement where we process those tailings and give them a royalty.
Hmm. Well, I think I'm starting to better understand how that works from that perspective. Maybe we can look into a little bit into the future. Then again, kind of related to my opening question here. So growth. I mean, is what you've done here with Codelco could you do it again? Is it replicable in other parts of the world or other mines? And yeah.
It is. It is because what we have done basically is finesse the art of working with low grade material, but high volume,
Hmm.
with high volume. You have that uh, when you're talking about the two variables that everybody looks at when producing copper. Well, one of them is the throughput. We have the throughput. We have a substantial amount of tailings that's coming from the mine. We're processing all of the fresh tailings. Nothing is being no tailing is being left behind here. All of the tailings are being run through the concentrator plant at MVC to recover additional copper. How we do it through a very typical process that involves classification, grinding, flotation. There's nothing out of the ordinary in how we do it. It's just the metallurgical discipline of working with the low grades. Uh, Everybody produces tailings. There are mines that have higher throughput in Chile than what El Teniente has.
Mm-hmm.
So, of course, the opportunity of replicating a similar operation in other mines exists under the right conditions. And I would say one of them, of course, is the availability of those tailings, the geographical location of where a tailings reprocessing plant can be built. You mentioned that we are receiving most of the tailings, all of the fresh tailings actually from via gravity. That's a significant positive attribute. We don't have El Teniente does not have to transport those tailings into a concentrator. They're basically coming down already. We're just diverting them into a bypass and then returning them to them. So that's a significant benefit. But I would also say that the business aspect of the relationship has been quite important. We have been exposed to investing the money, to running the company, to ensuring that the margins are there when copper prices have been low, and when copper prices are high, that we can control those costs to protect the margin. And in doing so, we have become beneficiaries of that through the risk and reward mechanism that I've described. If we were doing this for a fee, as perhaps some companies would expect a firm to work for them, recovering their tailings and paying them X, Y, or Z fee, that's not that interesting. That's not that interesting. What has worked here is the exposure to the risks and rewards of the copper business.
Yeah. Would working with Codelco on another operation be an option here? Is that something?
Absolutely.
That's
And
something
that is Codelco, not El Teniente, so you used it right.
Okay, that's right. Yeah. I just I do need help with a lot of stuff actually, but especially with that part of it. If you did pursue a second operation though, or a third or whatever, multiple operations here, Aurora, and I understand this is way forward looking, but what would your preference go to with regards to financing that growth? Would it be out of cash flow? Would it pause on the dividends? Would you issue equity? Take on more debt? What do you think?
That's a very preliminary question, Antonio. I mean, it would depend on a myriad of circumstances. So it's almost unrealistic to put myself in a box and say one option or another. An investment on another facility would probably require funding beyond the cash flow that's generated by MVC. In that case, I prefer debt. That's how we financed our expansion at MVC. We didn't dilute our shareholders. We took in $100 million of US debt and we'll be repaying it in full this year. And it worked well.
Hmm.
It worked well.
Talk to me a little bit more about that debt. How much do you have left in the books? How much interest does it carry? And what part of the year do you think it's going to be gone by?
That debt was originally taken with one bank in Chile and with Export Development Canada. I have to mention them because they were a significant um, party to our financing success back in the day. We took it in two tranches to do the expansion into phases. So we took $66 million first and then $34 million. We refinanced that debt in 2021, in June of 2021, with a different Chilean bank, actually a syndicate of two banks, but we don't mention their names. And that debt is currently sitting, depending on when the interview is going to. Anyways, today is June the 26th. We have $10.5 million of debt. We're going to be repaying 3.5 on June 30th. Another $500,000 comes in October. That would leave us under our original schedule of payments with 7 million, of which we have to pay 3.5 in December, but we're going to be paying the full 7 before year end. That debt was, we have a swap for 75% of the debt, and that was at 5.48%. And the remaining 25% is tied up to SOFR plus a margin, and it's currently around 8.5%.
Why I ask you that is because I'm thinking, well, it is costing you money. Money costs money, of course, but why not? Why return money to shareholders under a dividend before paying back the debt? What was that strategic decision based on?
Because our shareholders have been waiting for a dividend for a long time. We wanted to have full clearance and remove the shackles that we had under the prior agreement, which basically prevented us from making any shareholder distributions. So part of the refinancing of the debt in 2021 was to allow us to allocate free cash flow to shareholders.
Well, what happens when it is repaid? What dividend capacity will that add for you?
Well, normally around 9 million per year, because we were amortizing at a rate of 7 principal and 2 million of associated finance costs. So give or take $9 million of additional free cash flow to equity as of 2026.
5 cents per share at today's shares outstanding?
What do you say?
5 cents per share at today's, you've got 164 million shares outstanding, 9 million, that'll be give or take 5 million.
Yeah.
Yeah, that's interesting. Okay. Do you plan to keep both the dividend and the buybacks at the same time? Is that something you just want to keep kind of indefinitely, hopefully?
Yeah, I think it makes sense to have both. We actually have three different mechanisms within the capital return strategy, because the dividend, we have two dividends. We have the quarterly dividend and we have a performance dividend component.
Yep.
Both are quite important to distinguish one from the other, and the buyback. So I think the three aspects have really made our CRS, our capital return strategy, very successful.
Do you have why I'm asking about the buybacks and keeping that in place? That can be a controversial topic, I suppose, with some companies, and specifically because I'm thinking, do you have a negative growth number in mind when it comes down to your fully diluted shares? And really why I'm asking that is because while you are buying back shares right now, you're also still, giving options to insiders, which they get exercised and sold. So essentially they are adding shares to the registry, to the fully diluted shares. But of course, this being shareholder capital, you'd want it to have a positive effect on the overall pie and make it smaller, right? So is there a number that you'd like to shrink that pie by every year?
Well, if you look at our disclosure, and I talk about that in our earnings call a lot as well, our minimal commitment is not to have dilution on a year-on-year basis. That's the minimal commitment.
Okay, so essentially you want to buy back at least as many shares as what you're rewarding insiders with.
At least as the amount of shares that are issued annually in connection with the exercise of options.
Right. Is the way it's looking right now in 2025, is it looking like you're going to be on target for that goal?
Oh, we already beat our target for this year.
Okay, good. That'll be an interesting balance to follow as a whole. Again, it's something that I do pay attention to when it comes down to companies that are actually making money. And I've also not abandoned.
We report our share buybacks because it's a number that's important to our shareholders. It tunes them into how we're feeling about things on the market and everything else. So we report our share buybacks on a monthly basis on our website.
By the way, I've not abandoned the topic of growth. I'll go back to that now because this is kind of an in between, but it is important as well. Could in-process optimization also be a path to growth? As in, could metallurgical innovation lift recoveries here over time for you? And is that something that you'd be targeting?
We work on that. We work on that continuously. It's one of the KPIs of our production manager. We're not sitting here and just not doing anything. We're always looking to see what could happen. The growth in production that could come out from further optimization improvements, it's not going to bring you from 65 million to 75 million pounds. Let's be clear about that. But if you get 2 million of additional pounds production per year on an optimization initiative, that's great.
Yeah, that's what are you doing for it when you say you're working on it right now? What is it specifically that you can do to make it work?
We look, for example, at mechanical improvements, additional columns at X, Y, or Z location of the plant that could have an important effect on recovery optimization. Reagent changes, you name it. There's not a lot to look for that makes sense in terms of the return. We get numerous calls from vendors with equipment that has fantastic claims, and once you start analyzing it, it's not going to pay back at all. So, and we don't want to be their guinea pig. So, but anything realistic that can pay for itself, that has a good ROI, and that doesn't have any disruptions on another part of the process is important. We've looked at some optimization initiatives, for example, that when we start testing them, we see that they have some detrimental impact on another aspect of the plant. So we have to see that as it's like your body, right? You cannot just tweak it here without ignoring what could be happening on another part of your process. So we're very cognizant of that. We don't want disruptions. We don't want to mess what's working out so well for us.
I laugh when you tell me that vendors reach out to you because people reach out to me as well. They always want to improve my video editing or they want to write questions for me and stuff like that. And once you start looking into it, most of the times it doesn't really work. But I mean, making something, a little bit better for a longer period of time, it compounds and eventually.
Everything compounds, and compounding is a word that's significantly important in a business like ours. So we are very cognizant of that in terms of, choosing suppliers, the terms of a contract, even headcount. Like I have to approve every headcount increase at MVC, not because I want to micromanage MVC, because once you hire an employee, it has an effect on your finances for the next 10 years. So it's not just the cost for a year, it's how much is this going to cost me for 10 years, 15 years. So every decision, every change in an operation like ours, which is a mid-sized operation, has the potential to contribute to making it a little bit better or a little bit less good, worse. And you have to be careful about those little adjustments because they all have a long-term impact.
Well, what about on the other side of that coin and thinking about what could slow you down and have a impact on on the other side, and how you'd manage those potential risks, as you had mentioned earlier. There was a couple of things that I wrote down as potential things to talk about in terms of risks. There was a flood here in Q3 of 2023, which did hurt production. What are the risks of that happening again? And is there something you can do? Is there a rainfall threshold that you have to keep in mind or manage? Or how do you deal with the weather, essentially, is what I'm asking here.
Yeah, in at least since Amerigo has been the owner of the operation at MVC, we have survived an earthquake in 2007, I think it was, significant floods in 2023, a 10-year drought. So we are aware that risks beyond our control are our biggest risks, but we have to be ready for them. What happened in 2023 was that there was substantial rain in a very short period of time, and concurrently, the temperatures in Chile, it was around this time of the year, so they were going into winter time, were warmer than normal. So as the rain started pouring, snow couldn't be formed because it wasn't cold enough, and it was just a deluge going into MVC. But we had anticipated that that could occur, and we had actually wrapped all of our connecting lines between the historic tailings deposit into the concentrator plant with flotation equipment. And there's a really good video on our website. I think we posted that in December of 2024. Anyways, we have our full videos library available online, and it has footage of those anillos flotadores, those flotation rings. If we hadn't had those, that whole infrastructure could have been probably damaged beyond recovery. So we were proactive about that, and we were ready for it. Now, the rains were heavier than what we had expected, so we had some flooding in Cauquenes, and we didn't have enough pumping equipment to do it as quickly as we wanted. We now have that in. It's all ready. We haven't used them this year. That doesn't matter. It's great to have something in place that you don't necessarily are going to use, but that can significantly reduce your exposure should an event occur.
Hmm. What about on the other side of floods, which I suppose are droughts, and thinking about energy in that case? Chile's grid isn't the thickest piece of infrastructure out there. So what portion of your power is locked in under fixed pricing contracts versus just spot pricing? Is that all of it?
Yeah.
No risk at all to the power then in that case?
No, we have a long-term power contract to 2037. It is subject to US CPI adjustments on an annual basis. That's the tariff part, the tariff component. There's also a component to power cost that's called pass-through charges, and those are charges charged by the grid to industrial consumers. They vary, and they pick up on the economics of the grid system, and it's just basically a collective charge. Those are, first of all, based in pesos, so there's currency exposure to those. Although we have been favored with a weaker Chilean peso compared to the stronger copper price than we had been in prior years. But the main portion of our power is locked.
I do have a question about the currency, but I got to say, I do like how you answered my question before I was done asking it. And for the record, I didn't send any questions up front. So it seems like you've already been thinking about these things before I even asked them. So I suppose I'll put a green check mark to that. Now that we're on the topic of Chile, talk to me a little bit more about Chile as a jurisdiction to operate a processing facility in which, again, much different than actually doing the excavation yourself. But so you note in your presentation that obviously safe place to operate in and all that, but constitutional reforms, they somehow always find their way into the conversation. Where do you see the political winds blowing in the near future?
Did you mention constitutional reforms always find a way into the conversation?
Yeah, when I try to read stuff about Chile online, I always find, political reforms, changes, and stuff like that talked about.
That's I would give you that 2 years ago, 2, 3 years ago. There were actually two important constitutional reform exercises done by the current government in Chile. And both of them were olympically defeated at the polls. First, there was a proposal to basically come up with a brand new constitution, very progressive constitution, and it was voted no. We don't want that. The Chileans said, forget about it. Everything's working fine. Don't change what's not broken. And maybe this is, I've said that twice here. Don't change what's not broken at MVC. Don't change what's not broken at Chile. And then the current government came up with another exercise trying to modify the current constitution, and it was also voted down. So my reading of those two votes, popular votes, and your question about where do I see Chile? I see Chile as a leading example in how democracy should work in a Latin American setting, where there is a very transparent and a very natural transition of power every 4 years through a presidential election system that gives you either a party that's somewhat to the left or somewhat to the right. Most of the time, there is that change from tendency every 4 years. So we've seen very little instances where the left has remained for, I think it maybe 2 terms, but not 3 terms. So there's that pendulum that's moving from one side to the next, but it always points out to the center where growth can occur, where generational improvements are tangible from I've seen a different Chile. I've been going to Chile for 22 years. It's a different country now than it was before. It is progressive. It is getting more. It was great to start with. I'm not saying it wasn't, but it is moving ahead. Maybe slowly but surely. And that's okay. That's okay. There are no dramatic changes and dramatic promises and tendency disruptions going back and forth. I think that in general terms, the people in Chile are proud of their country, of what they have achieved, and are keen in preserving that continued growth within the macro structure that has been established since 1990, when democracy was reestablished in Chile.
Well, mentioning the people of Chile, maybe you can talk to me about community relationships here as well. How crucial is that for you relative to a miner? What's the situation for Amerigo right now?
Our situation is different because we're almost a suburban operation. We are located quite close to Santiago. Santiago is the capital of Chile. We're located around 80 kilometers away from Santiago. So if you arrive in Santiago at the airport, rent a car, and decide to visit MVC, you'll be there in an hour and a half. And you can drive all the way through with a brand new car if you want, because it's paved road from A to B. There's another city closer to our operation called Rancagua. Rancagua is the capital city of the region of O'Higgins, which is where our facility is located. And most of our employees live in Rancagua or in other surrounding communities, such as, for example, Machalí, Requinoa, Rancagua. Those are the 3 main communities. And from Rancagua to MVC, it's a 15-minute drive. So we are within the city almost. We're not contaminating, we're not polluting. Our workers are perhaps one of the few workers within the mining. I know that I don't call ourselves a mine, but a copper factory, but within the mining sector that can go and sleep at home every day, because it's almost like going to a factory to work and come back home. So we have great relations with the people of Rancagua, Machalí, and Requinoa. Those are the 3 communities. We have an outreach program with different themes: education, help for senior citizens, etc. We are a contributing obvious employer in the region. Outside of El Teniente, we are the single most significant employer in the region, and we are well respected and well regarded corporate citizen.
What percentage of your workforce is local?
100%.
All of it? It's just essentially just the corporate office is not, or like what? How does that
We
work?
are an anomaly. We are an anomaly in every way. We have 290 employees in Chile, living in Chile, working at the plant, and only the corporate side of Amerigo is located outside of Chile in Vancouver. So we have 4 people in Canada and 290 people doing the real work.
Hmm. Oh, that's it. So essentially, you have 223 people in the company. That's total employment.
294 people.
294. Okay. So wait, you said 219 in Chile.
290.
Oh, 290. Okay, yeah, got it. Got it. 294. Okay. Well, that's impressive, actually. I do want to ask about corporate G&A. We'll get to that hopefully here in a second. But essentially, you've not, just to stick on the topic of communities here for a second, you've not dealt with blockades or protests or anything like that. I remember something at Caserones last year or something like that. Have you dealt with something like that?
No.
Good, impressive. And I suppose on the still on the topic of Chile, just before we move on, and their currency, the Chilean peso is notoriously volatile. How much of a risk or a challenge or dependency does this volatility bring to the table for Amerigo?
Uh, it depends. It depends on the volatility. In the last 5 years, what we have seen is that for 4.5 years, it's a decoupling of the Chilean peso from the copper price. It used to be that the stronger the copper price, the stronger the Chilean peso, and that was basically the norm and the status for us for 15 years until 4 years ago or so. It could be attributed to the fact that Chile has right now its farthest leaning government since 1990, and that could have led to some perceived country risk influence on the currency behavior. Obviously, for us, a stronger Chilean peso means a higher cash cost, and vice versa. So we have benefited from that. I don't know what else I can say. There is dependency. All of our Chile, as I said, all of our workers are in Chile. They're paid in Chilean pesos. All of our maintenance work is carried out by Chilean companies. We're not parachuting people to do the work in Chile. Chile has excellent technicians, excellent mechanics, engineers, etc. So most of our costs, excluding power, excluding the steel for the power balls, is pegged to the Chilean peso.
Having 100% workforce in country local is actually impressive. So I'd expected a lower number. So that does make sense. What do you keep your cash in? Do you keep your cash in the peso, or do you convert it in treasuries, or what do you do with it?
We keep the necessary amount that we need in Chilean pesos for working capital purposes, because there's no point in playing the forex desk and trying to make a lot of gains or losses in the process. So, but I would say a portion as required is kept in pesos, and the surplus cash is kept in US dollars.
I trade the markets when you can make money and distribute it to shareholders. I like that motto there. And Aurora, I'm enjoying this conversation here, though it has been a bit high level so far. So let's maybe talk a little bit more specifically about your most recent quarterly numbers. I ran through it briefly earlier, and I noted, what was the main thing that happened there was the planned maintenance essentially, but revenue stayed flat. Net income fell 23%. copper prices went up 12% during the quarter. Is it the plain maintenance that's kind of eating into your spread here, and then you're going to be back up to speed, or how do you
Yes.
explain these numbers?
Yeah. Essentially, it's a plant maintenance shutdown. We always have a leaner quarter on a normal year because of that maintenance shutdown. That maintenance shutdown is quite significant for us and important because it's done at the same time that El Teniente shuts down for obvious reasons. We
Yep.
want to be basically aligned and not miss any. We don't want to have any production conflict with what they're doing and the tailings that they're sending down, and we don't want to miss not having the capacity of processing fresh tailings because we're doing our maintenance shutdown. So it used to occur always on the first quarter of the year, but with COVID it changed and it was moved to the third quarter. So if you look at our prior years, you would have seen that the third quarter was our weakest quarter. But this year they moved it back to the first quarter, and it's going to remain there. So it does have an effect. It means at least 10 years of not having operations online. We also spent more money during that quarter because we're conducting a significant portion of our sustaining CapEx work that has to be done for safety reasons with shutdown equipment. We bring in a substantial amount of additional workers in order to complete all the work that we need to do in 10 days and be finished and done. So it's always a disruptive quarter. It doesn't mean anything. It's factored into our guidance. We're guiding for 62.9 million pounds of copper this year. And as I stated on our earnings call, we are on track with that guidance. Don't take that quarter, multiply it by 4, and assume that that's the production you're going to be getting, because that's the wrong way of doing it.
Not always the same quarter either, is it? I mean, it was Q2 last year, if I'm not mistaken, that you had that annual shutdown, or
I don't know if it
might
was
be.
Q2 or Q3. I don't
Okay.
recall.
So you don't know when it's going to happen next year. Essentially, like it's not like it
We
happens.
It changes. It changes from year to year, and we basically adjust it to whatever El Teniente does. Right now, our information is that it will occur again in the Q1 of 2026.
Why do they shut down? What do they have to do?
Maintain the mine,
Okay.
and they have their big SAG mills. They have to shut them down, change linings. It's a full preventative maintenance shutdown. It's very common. It's very common. You may not hear a lot about it in your calls because everybody's exploring, but with producers, it's a fact of life.
I just assume they shut down the mine for a huge Getzuela party, and they all have a good time. That might be an idea in and of itself. Aurora smelting and refining charges, they fell 53% year on year this quarter, which is good. What's driving that? Is that permanent?
I, my view on smelter and refinery charges, Antonio, and I would say most copper producers' view is annual and not what's happening today or tomorrow or last week, because we are tied to what's called the annual benchmark. So we get our term set per contract with our through our offtake agreement based on the annual terms that are usually set in December of the prior year. So they did fell down considerably. We spoke about that in our guidance and provided the information to the market back in the day. But spot terms had been moving in similar downward direction through 2024. It didn't affect us because we were already tied up to the benchmark that was set up in December 2023.
Well, that makes
So
sense.
for us, it's a once a year game of just seeing what the benchmark is going to be like and abiding to that benchmark. Things could change in the future. There was a lot of discussion going into 2025 about the annual benchmark being gone and no one's going to accept it because everybody wants to have that exposure to the spot TCRCs that are declining. It didn't occur. So those are world order questions that are beyond our influence. So we're observers, and we have to go with whatever the market benchmark or a substitute, if it were to occur, brings us. But we're not exposed to spot TCRCs.
Is that not something that you can lock in under a contract for just a duration up until 2037 or something? Is that doable?
No, it is particular to each producer and its offtake agreement. In our offtake agreement, it's the annual benchmark. That's the setup for the TCRCs.
Right. Moly prices have fallen, and so your byproduct credits are this down 35%, I believe. What is the maybe we can talk a little bit about moly here, but what price is moly really a credit for you versus maybe costing you more to extract it than what it brings in?
It's a good credit right now. I mean, moly prices have been quite stable at around $21 per pound for the last 2 years. I think the last super spike in moly prices that we had was up to $31 per pound, maybe 2.5 years ago. We make good money with the moly price where it is. It could go down significantly from where it is now and still be a profitable operation for us. And moly is something that we have shut down in the past when we weren't making money, and it's very easy for us to shut down the moly production.
When moly prices go up, because they're volatile. Could you increase moly production? Like, I know that some producers have the ability to move to a different part of but yeah.
No, we can't. Moly is a byproduct, so we basically recover it as a byproduct of the concentrate recovery, the copper concentrate recovery process. There is more moly content in the historic tailings versus the fresh tailings. And for example, when moly was at $31 per pound, we were asked, well, why don't you just treat more historic tailings in order to get more moly? Moly is good for us. It's great. It's a byproduct. It doesn't guide how we run our mining plan. It is ancillary to our mining plan.
I also see that your effective tax rate has gone. I think it's up as far as I could read. 58%. It's what it's at right now. Is that where it's going to be? Is this one the new baseline? What's driving that up?
Where do you get that effective tax rate from?
Just well, I've written it down. I have it from the Q1 report. Is it wrong?
No, but okay. If it's the Q1 report, we don't break down the difference between current and deferred tax. I don't want to bore you with a lot of accounting stuff, but deferred tax is basically an accounting figure. It's included in the statement of operations as tax expense. It doesn't mean anything. It's just a way of tracing the differences, the timing differences between depreciation for tax purposes and accounting purposes. The tax rate in Chile, income tax rate, is 27% and has been 27% for more than a decade. It hasn't changed. There are no tax reforms on the books to change that tax rate. And we also have to pay a repatriation tax to bring surplus cash back into Canada. That's around 11%. Those are stable. Those have no projected changes in the future. That's the real cash, the real tax expense for us. Deferred tax changes. And perhaps I'm going to tell Carmen that we should break that down into in the quarterly report so that we can show both of those in the face of financial statements. But rest assured that movement in tax is not because the tax rate has increased, but because there's an accounting tax component affecting that tax number. Sorry about the boring answer.
No, this is important actually to better understand as to how much money it's going to cost you. We're talking as to what's going to cost you money. The four people that you've got outside of Chile on the corporate level, how much is that costing you to essentially keep the lights on?
I don't think it's important to go into all of the particulars. If you want to talk about the team in Chile, I think it's more important for investors to grasp who they are and what they're doing. They're paid a market rate. They have a bonus scheme. If they do a good job, as they do, they get their bonus. So I don't think it's relevant to anyone to see, well, how much are those four people costing me or not. Does that make sense?
Well, why I'm asking it is because it does, in the end, add into your all-in sustaining cost, as in your financing and everything really on top of it adds into at what point do you make money on pulling copper out of the ground? So that's really where I'm coming from, just basically trying to understand how the company spends money as a whole outside of your production, essentially.
Well, all of the people costs are included as cash cost. If you look at our components of cash cost on the notes of the financial statements, you will see that we report production cost, maintenance and services, and administration. So the production manager, he's part of the production cost. The maintenance manager or the sustainability and operational continuity manager is part of maintenance and services. Administration manager and GM in Chile, they're part of the administration cost in Chile, and those are all those are all bona fide expenses that we have on running that operation. And there are 4 employees in management and 286 employees reporting to those 4 managers.
Mm-hmm. Good. When you say you want to talk about the people in country, let's talk about it. Who's essentially running operations in country? What makes them qualified to run it, and so on and so forth? Yeah, talk to me about the in country team.
Sure. Sure. So we have a team of 4, the Fantastic Four in Chile. We have a general manager called Christian Cáceres. Christian is a metallurgical engineer. He also has an MBA. He has been with MBC since 1994. He has grown in the organization, probably started as an assistant supervisor and has gradually risen to his current position. He became general manager in 2015. So he already has 10 years tenure as GM. And we have 3 managers that each of them lead 3 silos that we consider are crucial to the success of our operation. We have obviously production. So we have a production manager, Julio Leiva. Julio is the youngest member of the team, but he joined MBC in 2009. He's in charge of devising the annual mining plan, all communications with El Teniente, running the concentrator plant, the moly plant, the historic tailings operations, metallurgy. So all of that responsibility falls under him. He's a chemical engineer with a master's in mineral processing and an MBA. Then we have Benjamin Campos. He's our sustainability and operational continuity manager. I actually would put it operational continuity and sustainability manager. Operational continuity is more important than just the sustainability aspect. He's an electrical engineer, joined MBC in 1997. He also has an MBA, has been with us for a long time, and he's in charge of all the maintenance work at the plant, all the sustainability compliance. Sustainability compliance is very important in Chile. It's under the radar of inspectors at all levels. So that we have a myriad of environmental commitments that have to be met, and we have to measure them, and we have to document how we're complying with all of those requirements. He's also in charge of engineering and IT. Then we have our Chilean CFO, Javier Tapia. He's in charge of finance, administration, purchases, management compliance, and safety. Safety is significant to us. We are very proud of having having reached more than 3 years without a single lost time accident at MVC. That means not a cut in a thumb, not a sprained ankle, nothing. We work 24/7. We have operations that are continuous 24/7, 365, and we haven't had a single accident. So we're very proud of that record. It's quite significant. So that's a team. That's a team in Chile. You can see they have long tenure with us. They have a solid technical background, and they're all committed and very proud of what they're doing at MVC.
You don't let the people go home for Christmas?
They're there. They're home. They're home.
That's fair, because they do go home on the back of the shift, I suppose.
Oh yeah. No. The shift that's there has to be there. That's the life of the miner. It's a 24/7 operation. Mines are 24/7 operations.
Looking at the realized price per pound here in Q1, Aurora, and how that fluctuates too, would you consider hedging some of the output at a fixed price?
No.
Why not?
We are exposed to copper. We are bullish on copper. We want that exposure to our shareholders. The people that are investing in Amerigo believe that copper prices are going to be robust, and there's a tendency for stronger copper prices in the future. They're here for the exposure. They're here for the exposure to copper prices.
Well, you can hedge half.
Half the upside?
Yeah.
Would you hedge half your upside?
Well, I would hedge half my downside.
If there's a downside, yes. If there's an outlook for a downside, yes. If you have, for example, different circumstances in different times, if you have debt repayments that you wouldn't be able to make, if copper prices suddenly plummeted, that's a different scenario, Antonio. But I think that under our circumstance where we have a clean balance sheet, we have a line of credit, we don't have major capex commitments ahead of us. We're here poised for the upside in copper.
But so you are saying that you would hedge under the right circumstances, but you don't think that
we have hedged in the past under the right circumstances. It has been very limited hedging, but when pushed to the wall, we hedged for protection purposes. But it's not our preference.
What would a world look like for you in order for you to hedge? Like, is it like if copper goes to $10 by the end of the year, you could lock in $10 contracts where you're printing cash essentially at $10. Would you hedge then, or what would it have to look like?
But we're not there. We're not there. I think that we are in a very mobile and upward moving situation where hedging could be detrimental if we were at the end of a cycle, if we were perceiving a sudden correction. And of course, it's very difficult to time those things, and hindsight is always 2020. But I don't think the time is right to look at hedging.
So when people talk about, if you open up YouTube, and I suppose, I understand that part of that is trying to generate viewership on YouTube, of course, but people talk about dire situations where, the end of the world is coming, essentially. It's going to be a huge recession. You don't see that coming. You don't foresee a hit on the copper price, and therefore you wouldn't hedge. Is that what you're saying?
I think that we rely more on the fundamental market analysis of supply and demand versus the old Dr. Copper as an economic bellwether story. I think circumstances are changing. There is a new paradigm coming along in terms even of the new global protectionism waves that are occurring, where you see that copper is seen as a more strategic commodity that everybody wants to have a hold on, to stock, to have a reserve of, and that some of that criticality aspect to copper may well change some of the pricing dynamics that were present in the last 20 years.
Switching gears here a little bit, Aurora. Your IR person reached out to me, wanted to do this interview essentially, which makes me think you'll be doing more marketing in the future. And I suppose given where the copper price is and where you see it going, that also makes sense. Is that the case? Do you want to do more marketing? And what are you planning for marketing this year?
I don't call it marketing. I think we have been keen on telling our story and on making our story known because we're a different company. A, a niche yield-oriented copper producer that has huge exposure to copper without a lot of the mining risk. And it's important for us for people to know who we are and what we're doing. We're not raising capital, we're returning capital, so we're not marketing. I think it's mostly just an outreach exercise in terms of telling the right people who we are, the people who we want to be shareholders of Amerigo, who we are and what we offer. But we're not marketing. We're communicating slash educating.
Why though? Why keep communicating if you're not and you're not necessarily planning on issuing equity? You're actually buying it back. So essentially, you'd be better off if the equity was cheaper. So what's the goal with the communication campaign?
It's having the right match between the shareholders that value an investment like ours and who we are. I think we have done a lot of progress in that sense, and we have a lot of shareholders that are the high quality shareholders, long-term shareholders that we want to have. But there are some people that there's always going to be people that reach their investment in criteria that have checked their gains and want to move out. And it's important for us as a public vehicle to have that to provide to shareholders that volume so that they can do whatever they want to do, and people that want to join us for the right reasons as shareholders do so.
It's really refreshing to hear that. That's been my excuse me, my whole idea behind building this whole program, where we do longer interviews, and they're not your punchy 5-minute interviews where it's essentially all about pumping a stock. And wanting to do it differently my hopes are that I would find companies that also see it the way that you see it. It's really refreshing to hear it. Most of the times it's just, companies saying, oh, we got to get our share price up because we got to issue capital and, raise money.
It's great. Don't get me wrong, Antonio. It's great to see share price movements like the ones we have seen in the last 2 days. But that's not what we're working for. That's not what we're working for. This is a long-term business with a long-term mindset of rewarding shareholders, but also rewarding everyone that's involved with it. I mean, first and foremost, our partner, Codelco, our employees. Corporations can be great agents of change, not just printers of money. I mean, there's a bigger mission here, but part of that mission is to reward the shareholders that have put their money into a company.
Sure. Yeah, that is again the right approach. I wish more companies would take that approach. I've tried to look at what's wrong, as you said at the beginning. What am I missing here? What's wrong? That's essentially what I've tried to do over the last, what has it been, an hour and 15, 20 minutes or something like that. I don't feel like I've been too successful because I haven't found too many things. What about yourself? You know the company obviously better than I do. What keeps you up at night? Or if you had a magic stick, you could wave it at something and make it go away. What's one risk that you would make go away?
There have been a lot of things that have kept me up at night in my 22 years with Amerigo. Some of those are just unavoidable. Copper price volatility has been a nightmarish issue at times. It's not now, and I'm not just being promotional here. I do believe in the fundamentals of the market, as I said before. So I think that for once we are on the right side of the cycle, and that's a great feeling. Water issues in Chile in general are always something to keep an eye on. We have come out of probably the worst part of a mega drought cycle that has lasted for 10 years, but the question remains, how is this going to continue evolving, and how can we ensure that in our operation we have all the water that we need and that we are well protected for it. So right now, the fact that we have a clear midterm horizon in front of us doesn't mean that this is something that we should just shelve and not worry about. So I think that water in general is an issue that is important for anyone working in Chile, not just in mining, in agriculture, in winemaking, in everything. We have a shared responsibility to see that it is something that, as a country, is managed well, and that it is a priority and continues to be a priority. Those are macro themes. On the day to day, it's important to keep your people stretched but not broken, motivated, growing, enthusiastic about showing up to work every day, and that's sometimes it's easier than others to do that. I'm internally very motivated, and I have to ensure that my team, my core team, the agent, the change agents at MVC and at Amerigo continue to champion our cause and to be, at 110%. 100% is not good enough. We have to be at 110%. But you also have to be realistic, because we have families, we have other interests. So how do you manage that? So trying to instill that sense of wonderment on a constant basis, it's challenging exercise.
Does that include cazuela? Is that how you keep your people happy?
You have done some search about Chilean food.
That's it. Yeah, exactly.
Yeah, we have that quite regularly at the MVC. It's called Casino. The MVC Casino. It's not a casino. It's the lunch room is called a casino in Chile. So it's one of the features, cazuela.
Well, maybe one day I'll get to come down and actually taste it. I don't think I've ever had it. I mean, it'll be interesting to see. I want to be respectful of your time here, Aurora, though. I think I've been through most of the questions that I wanted to go through already. I'm sure I'm forgetting a bunch of stuff. What do you think I'm forgetting? What did you come here hoping to talk about that I failed to bring up?
I think we've talked about a lot of the important stuff. The context of the relationship with Codelco obviously is 100% of who we are, so it's important. We talked a lot about that. Chilean context, our financials. I would just say to some of the people that may be listening to this in the future, look at the annual information. Don't lose yourself on a quarter. A quarter may tell you a different story than you should hear. So if you're going to research us or any other company, look at their annual results. Don't lose yourself in the details of what happens within a 3-month period. It's not enough.
Yeah. Well, getting mining investors to be long-term minded is one of the challenges of our industry. I think there's a lot of trading happening, but this really has been a good conversation. And for people listening and watching, if I've forgotten something that you think is important, please let me know. Put it in the comments or whatever, and hopefully Aurora and I can sit down for another conversation after the Q2 results, or maybe later down the road. But yeah, Aurora, I really appreciate your time. Thank you so much for sitting down with me today.
Thank you, Antonio. It was great.
And as always, thanks to everyone for watching Resource Talks. I have a couple of more things to say, though. The fact that this company was interviewed here today does not mean that they're necessarily a good or a bad company. I'm not here to endorse nor attack anyone. I am simply here to ask some questions. If you find that I have failed in asking a question that you would have liked to hear an answer to, which will happen as I'm not an experienced interviewer, please let me know, and I will try to correct that mistake in a future interview. As mentioned at the beginning, please understand that mineral exploration and development is an extremely risky business. Losing money is the norm and should be the expectation. This is a very complex sector, and the performance of individual companies typically depends on many different moving particles, including company-specific factors like geology, financing ability, and many others really, as well as particles that are outside of the company's control, like geopolitics, macroeconomics, commodity prices, and many more, most of which are nearly impossible to fully understand. Moreover, these companies that typically get interviewed on Resource Talks are in the pre-revenue stage, which means they rely on the public markets for the financing of their operations, which could result in shareholder dilution. Furthermore, as a general rule of thumb, you'll be better off understanding that all company communications online, albeit this interview or their website and their presentation and their social media accounts, or even the social media accounts which you thought were your friends and then told you about a stock, everything really that these companies do is intended as marketing. And although I do not make buy or sell recommendations because there is a clear conflict of interest given the nature of my business, many out there do. And you should be aware of that inherent bias, and you should be careful out there. That bias is not always going to be clearly disclosed with everyone out there. So it is safer for you anytime you're watching any type of company specific content to approach it with a dose of skepticism and assume that the party telling you about it is biased in at least some shape or form, because there will always be a bias. Again, albeit clear or not. So always ask yourself what the incentive of your counterparty is and never rely on them regardless of their incentives, but instead double check if what they're saying is true, again, by using setterplus.ca. The fact that I have no idea what I'm doing should already be clear to you at this point. I am not saying this to make jokes or laugh with myself. I just simply do not have a long enough track record of consistent investment profits. So I should under no circumstances be considered an authority on anything. Again, although this may sound amusing to you, believe me, it is not amusing and it is not intended as a joke. I'm simply pointing out a fact and warning you not to rely on anything I do or say. Unfortunately, at least to my understanding, nobody out there has any special abilities. The CEOs do not possess any superior knowledge, and they cannot know about what will go up, what will go down, or what will go in circles. Some people even believe that to be rule number one on Wall Street. Nobody really knows. None of us know whether any of the company's activities will result in a success, again, given that we're talking about high-risk activities where most of the times it ends in failure. So unfortunately, try as I may, I won't always catch all red flags or all challenges with the companies. So even if I did ask a few tough questions in here, don't rely on this being all of the tough questions. Again, these are complicated startups with many moving parts, and I am conflicted given the nature of this business. Therefore, I cannot guarantee the quality of anything presented in this video, and you cannot hold me responsible for any losses or damages stemming from the way you decide to use this interview. Viewers, listeners, and readers acknowledge and agree that the information presented herein did not constitute a solicitation or an offer to buy or sell any security or investment or to participate in any trading strategy. Resource Talks and all parties involved in the management of the business strictly disclaim any and all liability for losses and or damages, whether direct, indirect, special, or consequential, or other consequences, however so caused, arising out of any use or reproduction of the content published by Resource Talks or any decision made or action taken in reliance upon it. By consuming this content, all consumers vow to release Resource Talks and all parties involved in the management of the business from all claims, proceedings, or consequences. This is all to say, I know it's a lot of lawyer talk, but this is all to say that you shouldn't blindly trust me or anybody on the internet, and you should do your own research. Once again, social media is meant for entertainment. It is setterplus.ca where you do your research. That's where you'll find the company's official filings, and I encourage you to read and analyze the Management Information Circular, the financial statements, the Management Discussion and Analysis, and whenever available, the NI 43-101 technical documents. If you don't understand everything in those documents, the chances of you losing money are even higher than they normally are in this space. And as mentioned earlier, the chances of even the best analysts in this sector losing money are extremely high, since this is venture capital and it is not for everybody. I'll leave you with one of Charlie Munger's quotes, which I wish I had listened to more often earlier on, which says, quote, "If you don't understand it, don't do it."